Hello, good night. Tonight will be a financial video. I do have a couple points and subjects that I want to go over, and I will be explaining them from the view or perspective of my experience. So first, when to take profits, a GME story. So you have GameStop right now, and of course it's been trending up or was trending up last week. That is still an ongoing incident situation, if you will. That may even threaten the markets in some cases in terms of liquidity for some of these higher level brokerage firms that pay the lower level brokerage firms for what they call trade flow. And that's one of the ways that these brokerage firms such as Robinhood and M1 Finance, which is what I use, this is one way they make money. I will be actually going a little bit into that more pretty soon. There's ways that they make money or they have some type of trade-off by paying for that trade flow. In terms of just going over pure when to take profits, it's really an idea of your own paranoia and your tolerances. So for instance, you may have a stock or even a cryptocurrency that you've done 5x on. Personally, that happened with me early on in the year. I bought about 5 Ethereum. Or early on in 2020, I bought about 5 Ethereum and then sold a little bit off as I needed it, especially when to fund the closing of my home here. Excuse me. And essentially what I did is I looked at it and I said, how much money do I need and how much money do I want to leave on the table? I had already made back my original investment, which was about $1,000 because I bought them at $200 a coin. And then I went ahead and took profit. I didn't take too much off I didn't take all of it off the table. I had close to about 8-10 coins. Sorry if I'm fidgeting a lot. I had a real bad back problem the other day, or upper back problem, probably from working out. But in terms of when to take profits, what I did on that is I followed a simple rule, and I have the article, or the article will be in the description box below, that describes a little bit of this. Usual rule of thumb is take 20 to 25% off the table. So I went ahead and followed that, and I took about 20 to 25% off the table each time that it hit highs or hit certain markers. Now that is what I did after I did went through with the closing for my home, because Ethereum just started to pump up past $1,000 a couple weeks ago. So what I did is I looked at it and I said, hey, listen, I want about like $2,000, $3,000. You could do this any which way. I usually like to take at least the original investment out after a certain period of time, as long as I'm making pretty decent money on it. In terms of, and when I say decent money, these are all things that are subjective. These aren't always an objective way of looking at it or a scientific way of looking at it from my perspective or standpoint, or even most retail traders like myself will look at it as, hey, I want this much money, let me take it out. And that's pretty much it. Now, in terms of what hedge funds, ETFs, or fund managers do, is they will look at it, and they will look at it from the tolerance and allocation, or the amount of allocation of their fund that goes towards that actual security, ETF, ETN, what have you, or stock. So when it comes to something like that, what they'll do is they'll try to keep it within like a 10%, 20%, or what have you of their portfolio. So that means, for instance, ETF or a fund manager like Kathy Wood of ARK Invest, they would have Tesla, and maybe they have Tesla at 10%. Tesla's done very well. They won't keep it in their fund, or they won't keep that high allocation towards Tesla for a long period of time, because it does not fall within their actual tolerance level and what they want to, what do they call it? It won't fall within their acceptable tolerance levels for that actual security. Essentially, your portfolio can get really out of whack, and by it getting out of whack, that could expose you to certain market risk. That could expose you to certain market risks that you can actually fight against by diversifying and spreading that money out across some of your other investments in your portfolio, fund, what have you. So this is something that happens quite a bit. I will be making a video about rebalancing. Basically, to make it short, rebalancing is really Actually, no, I'll be making a video about that right now. But portfolio rebalancing basically is just making sure that things are within the initial levels that you put out. So for instance, if you have a certain sector at a certain percentage, you keep it at that percentage, whether it does well or it doesn't, meaning putting more money towards it or taking money out of it. So in terms of GameStop, getting back to how to handle taking profits on that. For something like GameStop, I would have probably taken, if I had, so I was in the market, especially when GameStop was at $4.10. And if I had put in about $410, that would have gotten me, and $410, and from where it moved to, and if it moved up to say like $410 a share from $4.10, I would have probably taken, on the way up, I would have been slowly chipping away at it. By the end of it, I probably would have had maybe about $25,000 to $30,000. That's if it had moved up to like $4 something. It actually got close to that, actually, which is pretty nice. And it may actually go even farther than that, depending on what happens tomorrow in the market. Tonight is Sunday the 31st, so we'll see what happens on February 1st. If it'll be like a bit of a massacre or something like that, we'll see how that happens, or how that affects the market. But something like that, I would have actually gone just using GameStop or even Ethereum. I would have just chipped away at it, taken a little bit of money off the table, do what they call, like, putting some dry powder away, maybe even taking that and investing it into other stocks or even cryptocurrencies, so I can actually ride that volatility or the wave of volatility in that market. It has a little bit of blood in that market too. It's some of the coins are bleeding, so we'll see how that actually works out in the next couple weeks. But it's something that you really have to look at and just think about to yourself, hey, what is best for me? What can I stand to lose? And how can I make sure that whatever money that I put into this, look at what is a comfortable amount of money that I can actually make from this. And that's a very important thing. As I said, it's subjective, and it's something where you can wait and hold on for a long time, and maybe until it falls into zero, or you can actually get out on a high note, and maybe it rides up a little bit more after that, but who cares? I did the same thing with silver as well to fund the closing of this home. I think I sold my silver. I was buying in at $14 an ounce, and I sold about 135 ounces. 135 ounces at about $25 an ounce. So something like that, that was a pretty decent payday on that. And I had to pay little to no, I don't think I actually had to pay any fees. I got it for my market value. I didn't have to pay any buyback fees to my silver dealer. So usually what they charge is probably, say for instance, they'll charge you about $2 under whatever the market price is. And when they sell it to you, they charge you $2 over what the market price is. And that's how they make their money. And that's essentially kind of like trade flows a little bit. All right, going into rebalancing. To close up this video, talking about portfolio rebalancing. That, again, is something that is on the subjective side. What are your tolerances? So in some cases, parts of my portfolio, I am completely out of whack, especially on my Roth IRA, which takes up about 74% of my actual portfolio, when it's actually only supposed to take up 25. But mine is so far out of whack because tech has done so well and everything has done so well in a bull market. Now, I've thought about, hey, I've done research on when to do a rebalance, when's the best time, should I do it while the market is up, should I do it while the market is low? And they all really kind of come to the same conclusion of you should do it within your tolerance level. You should do it and follow the original plan that you actually have for your portfolio or fund or trust or what have you. Which means that if you had it at 10% or 25% of your portfolio, then you should keep it at that. If it gets too far out of whack, maybe you should rebalance every year, the frequency of rebalancing actually changes, or actually is also dependent on you as well, and what your needs and actually what your tolerance levels are. So for instance, if you wanted to rebalance every quarter, you can. But if you wanted to rebalance once a year and let things ride out, in a sense, it's kind of like letting the weeds grow a little bit. And then every so often you come in and you start doing a little chipping away and pulling out the weeds and making things look pretty and nice and orderly again. So that's one thing that I learned from my research on rebalancing, and even selling to take profit. Do it when you're comfortable. Do it when, not so much when the market is high, but if you're in a point in the market, know when to get out. Don't be too greedy. Like the famous saying that a lot of people repeat, when people are greedy, when people are fearful, be greedy. When people are greedy, be fearful. So in this case, a lot of people are greedy on GameStop. I'm totally fearful of that. I am not going to chase that bullet, because it also might be a falling knife. Or I'm not going to chase that bullet, nor am I going to try and catch that falling knife. That is definitely going to be something that could actually turn out pretty bad. But right now, it's freaking sick. And whoever's in on it, I hope you're making good money on it. But look at ways to at least get your initial investment on the security out, and put that money aside and probably put it into other things. Maybe things that can actually make you money over time, such as dividend producing stocks. That is definitely something. That is definitely something. If I was in on GameStop, I would definitely take all that money. Depending on, like, if I put in like $400 when it was $4, $410 when it was $4.10, I think that would have got me quite a few shares. And yeah, that should have been 100 shares. If I would have got 100 shares and that would have got up to $410 a share, oh man, that would have been sick. And I know people don't like this, but I gotta actually do a calculation on that. That would have been absolutely sick. But it's $410 divided by $4.10, 100 shares times $410. That would have been about 41 grand before taxes or anything like that. I would have definitely loved to have been in on that, and I would have taken that, paid off my truck, and actually done a couple other things, and take that money and put it into something like AT&T or any other one of my dividend producing stocks. And that would have just been one of those like YOLO moves. It may never happen again. This market is crazy. I'm going to bed. There's enough internet for the day. So that would have been a great move. If it could have happened, if I would have gotten into it. And actually I was in GameStop, but I had like such a small share and I wasn't focusing on it. I was focusing mostly on Tesla. I didn't know anything about what was going on with the planned short squeeze. In Wall Street Bets. I never really got into there, or I never get into that forum. I'm not a Reddit person, but it's a beautiful thing in terms of what people are doing. Actually, what I am doing in terms of a YOLO move is I've actually taken out another collateralized loan against my trading portfolio, about $2,900, and I'm going to put that in Ethereum and XLM. So I'm going to take that, put that into the cryptocurrency market, and see what happens by the end of the year. If our country starts to get our economy becomes a little bit more destabilized, I'm hoping that will actually increase cryptocurrencies. But the downside of that is we could want a lot of these big banks and hedge funds and things like that to fail. But what happens when there's no liquidity in the market, or little to no liquidity in the market, and you're having a hard time getting your money out? That's going to be a serious issue. But at the same time, if you put in assets that you feel that can actually be used at any point in time, then that's good. A lot of people would like to be more conservative and put that into things like precious metals and ammo, or food as well. Canned goods and stuff like that. So with that being said, take what if you're not taking, sorry, I got my little saying. If you're not taking what I say with a grain of salt, then you're low on sodium. Please do your research. Look at some of the articles that I post, some of the videos that I posted in the description box below, and I hope this helps somebody. It's my opinion, and it's my experience, and this is what I'm doing. I'll let you know if I screw up or not. But I hope this helps somebody. And with that being said, have a nice one. Bye.